Hi guys, it's Stephanie, and I have Robert here with me, who is a loan originator and he is a specialist when it comes to investor loans, which I know is really interesting for everybody. So, why don't you introduce yourself, Robert, and tell us a little bit more about what you do, your experience, and how you can help people with investor loans?
For sure, yeah. I've actually been. My name's Robert Perera. I'm here in South Florida, but I can pretty much do loans anywhere in the United States. But I mostly work here in Florida. Um, I've been in the mortgage industry since '08. So I've been doing this for quite a while. I love investments. I think it's a great way for people to gain passive income. So it's sort of a passion of mine, these investment type loans for people to be able to create some sort of passive income and honestly create equity and things of that nature. It's a great thing. So I'm really passionate about this topic.
Awesome. So, I have a question, which a lot of
Yeah.
people ask me this question, and I know you can definitely explain it better than I can. What is a DSCR loan?
Okay. Well, the exact terminology of it is a debt service coverage ratio, right? That's still just super fancy term, right? So
Yeah.
basically, all a DSCR loan, an investor is looking at how much the rent will cover the payment, right? So if the rent, I'm gonna go super simple here. Let's say you have $1,000 rental property that's how much you can charge for it, $1,000 a month. They're looking to make sure the mortgage payment is $1,000 a month, right? It can be less, it can be more. It doesn't have to be exactly that. Obviously, if you have a $1,200 payment and your mortgage payment is only $1,000, that's even better for the investor. They'll give you better rates, they'll give you better down payment, all that, right? But usually what they look for is that one to one, $1,000 rental income and $1,000 mortgage payment. And basically, we don't look at anything other than that. We look at your credit score and we look at that. Make sure we get an appraisal that the value is there, and that's all we look at. So when we go do the verification of all the information, is super simple. We're doing an appraisal, we're getting your credit, and we run with it, right? A lot of people like it for the simplicity. Some people prefer it, like they might be able to get another type of investment loan, but since this one's so simple, they prefer to do the simple one rather than another type of investment loan, just so they don't have to go through their finances. We don't have to worry about W-2s or pay stubs or W-2s or anything, right? It's literally just the appraisal and your credit.
So I feel like you kind of answered my next question already, but
Okay.
what a lot of people want to know is, so what is different with a DSCR loan versus a conventional or an FHA loan?
So, I mean, there's a couple of differences, right? FHA, there's always mortgage insurance, and on top of that, the paperwork for FHA is significantly more than a DSCR loan. The good things about a Fannie Mae, Freddie Mac conventional type loan is the rate will probably be a little bit better. 99% of the time, the rate is going to be better on a regular conventional loan, even when you're putting 20% down like you would for a DSCR. But there's a lot more paperwork involved, right? For people that are self-employed, they don't like, it's hard sometimes to verify the income on your taxes. There are programs that do bank statements and things of that nature, but again, it's a lot more paperwork, it's a lot more behind it. But that's why for the investor, for the lenders, for our side, the rate's a little bit higher because we're taking more of a risk, right, on providing the loan. So it's really more of a convenience thing for a lot of investors. And there's also other people that can't afford another property. So if they cannot afford another property when it comes to their taxes and income and things of that nature, DSCR is the perfect way to go, because all they look at are those scores. Your credit score is good and you're making the payment per month.
Awesome. So which type of investor is this best suited for?
Any type of investor. I mean, it's not, you don't have to go specifically to any type. It could be a first timer, never done it before, never had a rental property. Again, the rates might be a little bit higher in that situation. But it's definitely looking for one that either wants convenience, that doesn't want to go through all the paperwork of the taxes and things of that nature. Um, or someone that can't afford it per their income, right? So if you don't have enough income to qualify for a second property, you use this, it covers everything for you, right? It's just your, again, your the money that's coming in and your credit score.
Awesome. So basically, this is something for somebody, let's say somebody who might have inherited some money and has good credit, but as far as like their income, it looks like they would not be able to afford this naturally. And then they just take the property and use that as an income. Of course, you need to have the down payment.
Right.
And that would be a situation
Well,
where you could use that, right?
yeah, definitely. I've actually had people that currently own a home, and what they do is they get a HELOC on the current property they have. They use that money towards a down payment for the next one or a second mortgage, right? HELOC, second mortgage, doesn't matter. They get that money from there, and then they use it towards the next home, right? And that's how they start their investment property, right? So that's why I say it's really for anybody, right? As long as you can get some sort of down payment put together for it, it's an ideal project for anybody. And I think using the equity from your home is the best way of doing that, right? If you have money sitting in your home and you're not using it, use it, right? Use it towards a future investment and continue to build equity then on your home and on the investment property. And then the next time another one comes up, you have the same thing all over again.
Yeah, that's actually something that I've done and that I see other people do. Like once you get started, like once you have a property, it might be your own property, might be an investment property, you can use some cash out refinance options and then take
Right,
that money and then use that for the DSCR and then kind of like,
right,
keep the ball rolling if everything
right.
goes well, of course.
Yeah.
That brings me to the next question. You kind of
Mhm.
answered already a little bit. What are the credit score and reserve requirements?
So the credit score, I've seen it as low as a 640 to be comfortable, right? Um, I've actually honestly seen a 620, but that rate was just all this world high. And reserves, they do require at least 3 months reserves, right? Um, for any property. You're gonna require, and again, the lower your credit score, the higher you're probably gonna have to have some sort of reserve. The higher your credit score and the higher the rate is of the DSCR, the less reserve and less down payment you're gonna need.
Of course. And then usually like the lowest down payments that you see is 20%, right?
Yes, definitely. I actually just this morning I was working on one that was a 20% down. They had excellent credit, right? We knew the ratio. The ratio was above the one that we were looking for. Their credit score was 780. We were able to get them something for 20% down very easily.
Yeah, so basically, because I know this, I've done these before. So basically, like let's say the less you want to put in, the more you have to make sure that the property is amazing and that your credit and
Of
everything.
course.
It's always like a little like everything has to come
Yeah,
together.
Yeah, it's definitely a combination of the two. The property has to value where it needs to value, and your credit score needs to be there, right? It's not that it can't happen another way, but you're gonna have to put more of a down payment, or you're gonna have and or have more reserves, right? Both of those things make a difference. But it's not impossible. It's just we have to work for
Yeah.
it.
Now, how about short-term rentals? Can you do this if you want to do an Airbnb?
Yeah, actually, that's something I found out pretty recently. I would say in the last 6 months or so, I've recently found out that now they have a program with the appraisers that they can get short-term rental income as the value, right? So we usually had appraisals that just showed the long-term rental is now what it's called, right? The regular rental that we do, long-term rental rates of that area. Now they have a short-term rental rate of that area that can be used for DSCR, which is obviously a great benefit, right? Because if a lot of times the short-term rental is higher than the long-term rental, and we can use that towards the DSCRs, which is great.
Awesome. Now, real estate agents like myself, how would you recommend to them? How can they teach their clients about these type of programs?
I mean, I think they're pretty simple programs, right? I don't, they sound, when you say DSCR, you say debt service coverage ratio, and you
Sounds
say
fancy.
all these fancy words, like they just sound intimidating, right? I think the best way is just trying to break it down to very, very, very simple terms for everybody, right? If your mortgage payment is covered by your rent, you're good, right? Like that's the most simple way to break it down to anybody, right? Your credit score is good and your rent that you're going to be charging per month is okay. You can get this done, right? Obviously, you need the 20% down, you need the credit, you need the reserves, but in the most simplistic terms possible is the way I try to explain it to people. If your mortgage payment covers your I'm sorry, if your rent payment covers your mortgage payment, we're golden.
And then the last question, which we kind of already touched on, if somebody wants to build up their portfolio with DSCR loans up to like 10 or more properties, how would you? I have a take on that too, but I want you to answer first.
For
How would
sure.
you tell them to do that if they want to have more and more properties using this type of loan?
So the majority of these properties are up, or programs will allow up to 20 properties, right? So that's pretty significant number for DSCR, right? If you can get up to 20 properties that you can get under a DSCR, under the majority. There's some that do a little bit more, but those are, again, the rates start to go a lot higher and the reserves become a lot higher and the down payments become a lot higher. But it's up to 20%. And I think we talked about, like you said, we talked about it a little bit. Just start using the equity on all the other ones you're gaining, pull out the equity on that one and put it as a down payment on the next one, right? You can, honestly, a lot of people do is they buy a property that needs work, right? They'll fix it up a little, maybe not a complete redo, right? But hey, you need a new kitchen, a new bathroom. It costs you a few $1,000s. All of a sudden, your equity is increased in that same property. Your rental value has gone up in that same property. You're able to now pull out another equity line, and now you're able to use that for the next one. Or like you said earlier, refi out of it, get a better rate when you do the refi, get that money, use it for the next one, and you just keep on rolling and rolling and rolling on.
Yeah, exactly. So the way that you can do this is, of course, like if you don't want to do this with the refinancing, then you would always just obviously have to come up with the money for the down payment, make sure that you have a good property. I would help you find the property, and then Robert will help you make sure it qualifies. So we would have to
Yeah.
work together on this. And
Yeah.
that would be the way, there's different ways of doing this. Can you can do this with how many units? Or
So there are different products that offer different ones. Most of them are 1 to 4 units.
Mhm.
There are some that do up to 8 units. I haven't seen above 8 units. I've actually haven't attempted above 8 units, but I know you can do up to 8 units. Again, the more units, the higher probability of the rates going a little bit higher and things of that nature. But most of these are between 1 and 4 units. Um, and the rates stay pretty much the same for anything like that.
Awesome. Well, thank you so much, Robert. I feel like that was hopefully very helpful. You guys, if you guys want any more information on any of these things that we touched on or anything else that has to do with mortgages, feel free to reach out to Robert. And if you need any information on the housing market here in South Florida, then reach out to me. I'm going to include our information down below. See you guys next time.
Thank you guys.